Hi, my name is Paul, and Goeasy just reported some really detailed information in their third quarter earnings results. So I'm going to break it down and discuss whether or not I think the shares are under or overvalued. But really quickly, for anyone who might have clicked on this video not knowing anything about Goeasy, Goeasy is a Canadian company that trades on the TSX under the ticker symbol GSY. The company's business has two main segments: the Easy Financial segment, which offers different types of loans and ancillary products to people who have less than ideal credit scores, and the Easy Home segment, which offers lease-to-own furniture, appliances, and electronics. These segments operate out of physical retail branches as well as through their own online platforms and through partnerships with merchants at the point of sale, both online and in person. Finally, Goeasy's business model is designed to provide flexible and easy to understand lending services to customers who would otherwise be taken advantage of by predatory payday lenders. Now, historically, Goeasy has produced really strong growth, often beating analyst expectations, and this quarter was more of the same. This time around, the company achieved a new record for underwritten loans, pushing past the $720 million mark, and this bumped the value of the total loan book to over $3.4 billion, which is a gain of over 32% from this point last year. And while this strong growth sounds impressive, it isn't actually indicative of Goeasy's total growth potential. See, Goeasy has been taking measures to strengthen their loan book and reduce expenses in order to protect against the knock-on effects of rising interest rates. These measures involved increasing the number of loans that are secured by collateral, increasing interest rates on their loans, closing down 4 physical branch locations, and turning down over 85% of loan applications. Yet, despite these conservative maneuvers, the company is still experiencing tremendous growth. If you're wondering how this can be happening, on the conference call, the management touched on several factors that are allowing the company to surge in spite of these stringent precautions. First is that the banks have been tightening up on their lending. So higher quality borrowers who are formerly borrowing from the banks are now turning to Goeasy. And this influx of quality borrowers has also helped to push the average credit score to the highest point in the company's history, 617. Second, the company just rolled out its new mobile app this quarter, which received over 66,000 downloads and over 85,000 of those downloads translated into signups, which has already generated over 6,500 loan applications. Third, because of Canada's announced plan for regulatory changes to the maximum allowable interest rate on loans, in addition to the increased cost of borrowing, a large chunk of Goeasy's competition has exited the market. In prior quarters, this was just an expectation, but in this quarter, these expectations materialized as the number of companies bidding against Goeasy to achieve priority search results on Google declined by 40%, according to the management. So, nearly half of Goeasy's competitors stopped competing against Goeasy on the world's primary search engine. Next, Goeasy is now at the point in its life cycle where it's achieving the optimal benefit from operating leverage. See, Goeasy has, for the most part, completed the development of its branch network, algorithms, and financing facilities. So it costs very little to underwrite additional contracts and grow. This means that as the company's revenues grow, margins will expand, since most of the costs are fixed, meaning that each new customer is highly accretive to profitability. Also contributing to this high level of profitability was the management's decision to cut down on expenses post-COVID, in anticipation of a potential macroeconomic slowdown and regulatory headwinds. And finally, Goeasy's scale relative to its competitors in the non-prime lending space allows Goeasy to provide attractive lending rates for borrowers that underprice the competition. These 6 factors, in addition to Goeasy's reputation for being a transparent and flexible lender who cares about the financial future of its borrowers, have all contributed to the company taking disproportionate amounts of market share while growing profits substantially, and while being very selective in their underwriting. To give you an idea of how strong demand is for Goeasy's lending services, the company had a record 528,000 loan applications this quarter, resulting in a new quarterly record of over 42,700 new customers. And this really strong customer growth did produce similarly strong revenue growth, which was up nearly 23% from last year's third quarter. Meanwhile, The company's conservatism resulted in lower net charge-offs, i.e. loans that aren't able to be collected, and a lower percentage of loan loss provisions, or money that has to be put aside to cover potential future defaults. So that's great to see, but it doesn't necessarily mean that the company's revenues outpaced expenses. See, Goeasy has done a great job of reducing fixed costs, but variable costs, as the name implies, do fluctuate and can outweigh the job that the management has done to reduce the fixed costs. For instance, if the management cuts out a branch or branches that aren't necessary for ongoing operations or growth, that will reduce the fixed costs of keeping those particular branches open. However, if federal interest rates increase, this may raise the variable costs pretty substantially, especially for a company like Goeasy who utilizes debt in order to grow their loan book faster. Thankfully, in Goeasy's case, this quarter the 23% revenue growth did grow much faster than the operating expenses, which grew by about 14%. The end result of this discrepancy was that Goeasy's adjusted earnings per share hit $3.81, up over 29% from last year's $2.95 in the same quarter. And like I always say in Goeasy analysis videos, I generally prefer to look at earnings per share as opposed to free cash flow per share in order to measure the profitability of the company, since Goeasy's business model involves lending out a bunch of money up front that is expected to be paid back with interest over the period of several years. The key difference between free cash flow and net income, which is used to drive EPS, is that free cash flow measures how much money came in versus how much money went out during the operating of the business. So a large amount going out as a loan and a small portion of the principal plus interest coming back in makes the company look like it's losing money when using the free cash flow metric, even though those loans will be paid back in full over time and profits are being generated. Meanwhile, the net income metric does not classify Goeasy's lending as expenses. It instead deducts the interest expenses on Goeasy's borrowings as well as the operating expenses like charge-offs from the revenues generated on Goeasy's lending. With that, let's move on and take a look at the liquidity. And it looks like Goeasy is carrying roughly $2.67 billion of debt, which means that the company took out about $156 million in additional debt within the quarter. Meanwhile, the company has about $84 million of cash and equivalents and access to an additional $847 million of debt thanks to the company's debt facilities. So this quarter, the company both took out more debt and increased their maximum withdrawal allowance by increasing their automotive securitization facility by $175 million. Now, this might sound like it's going against the CEO's words last quarter when he responded to an analyst claiming that the company doesn't need to issue more shares and won't need to take out additional debt to fund growth. But as I mentioned in last quarter's video, I thought that in regards to the debt, this should be interpreted as more of a future goal. And the company taking out debt this quarter seems to prove my hypothesis partly correct, though I was also partly wrong in my interpretation that the company wouldn't look to increase its maximum debt capacity, which it did end up doing. And we did get more information on that, but first I'm going to check to see if there was any dilution done, since not issuing more shares for financing was also part of the CEO's claim. And as you can see here, it looks like there was only about $1 million worth of share issuance done within the quarter, which for a company with a market value of over $2 billion is basically nothing. Anyway, getting back to the CEO's statements regarding the company being able to fund its own growth, first we learned that nearly 50% of the company's quarterly loan book growth was able to be funded by the company's free cash flow from operations, which is the company's adjusted version of the normal free cash flow metric. But regardless of that, about half of the company's growth is still being funded via debt, which isn't necessarily a bad thing, but it does seem like it will be at least a few quarters before the company is no longer reliant on debt to fund their growth. Furthermore, we learned that according to the management, they expect that they'll be able to grow their loan book value by about $250 million per year solely from the operating cash flows. But if the company were to fully utilize all of their current available debt, they would be able to leverage the borrowed capital in order to grow the loan book by over $400 million annually. Plus, the management noted that if they chose to focus solely on paying down all debts, they would be able to do so in approximately 16 months. Though this would mean cutting the dividend and halting growth, so don't start expecting this hypothetical scenario to actually happen. Summarizing all of this, it sounds like the company could go debt-free if they really wanted to, but instead they're trying to capitalize on the higher levels of operating leverage and shrinking competition to take market share and grow, which, in my opinion, is probably the best course of action for the long term. And while we're on the topic of debt, the company's debentures, which were issued in 2019, are going to be coming due late next year, and the company wants to get ahead of this by refinancing in this upcoming quarter. This means that a new set of debentures will likely be issued at a higher rate because the cost of borrowing has increased since 2019, which does unfortunately mean that the company will have to be paying a bit more in interest expenses, though in the grand scheme of things, this isn't overly consequential considering the portion of total debt that these debentures make up. It's just something to be aware of. Then we come to the future outlook, which was another bright spot in an overall glowing quarter. Now, the 3-year forecast did stay the same, but that's only because the company revises these projections at the midpoint and end of each fiscal year. On the conference call and in the investor presentation, the CEO stated with no uncertainty that Goeasy is well on their way to surpassing their 2023 full-year predictions. So when the forecast is updated next quarter, we will likely see some improved figures. Plus, it should be noted that the mean of these projections assume a recession in 2024, wherein unemployment hits 7%. So if a moderate to mild recession doesn't end up materializing, the future projections might also need to be adjusted upwards. Unfortunately, no one can accurately project future recessions or their impacts, so take all of this with a giant grain of salt. Still, the management is confident that they will be able to maintain stable credit performance even if the economy takes a turn for the worse, which is good news considering that my top worry is the unknowns of how things will play out in an actual recession scenario. Noting that, as things stand currently, Goeasy's customers don't seem to be the group who are struggling to pay back their loans. See, with the recent rises in interest rates, the group that's currently struggling the most happens to be people who have mortgages on their homes. This is especially the case for recent home buyers, whose mortgages are now approaching, or might even be above in some instances, a 7% APR. Now, only 5 or so years ago, rates were as low as 2.5%. This means that a mortgage in 2018 that required $25,000 in annual payments might now require payments upwards of $70,000 in order to stick to the amortization schedule. This, of course, is a huge issue for anyone whose mortgage payments were already pushing the bounds of what could be budgeted for back when rates were lower, as those homeowners are now likely getting eviscerated by the much higher interest payments. Luckily for Goeasy, homeowners tend to be prime borrowers, while non-prime borrowers tend to struggle more with their finances and are much less likely to find themselves in the position to purchase a home. Thus, Goeasy's clientele are less likely to be experiencing an extreme shift downward in their financial situation than the recent homeowners. That said, this is far from cause for celebration, and not just because doing so would be in bad taste. See, between 2015 and 2018, an average of 45,000 homes were sold each month in Canada at mortgage rates that were on average a touch below 4.25%. Meanwhile, those same homes are now requiring payments that are 50% higher on average. This bumped the average mortgage payment on recently purchased homes from $21,000 to over $32,000. Or, to better put that into perspective, it went from being a little under a third of the median annual household income to slightly under half. This drastic change is likely pushing serious cutbacks in lifestyle and retirement savings, not to mention foreclosures and bankruptcies. These challenges could possibly pose a threat to the economic health of Canada, because when less people are able to spend on goods and services, more people get laid off and more companies pause hiring. Unfortunately, these hiring freezes and layoffs tend to have a disproportionately negative impact on the less wealthy, since they're less likely to have emergency savings to weather the storm. Meanwhile, the working class generally tends to make up a large part of the non-prime borrowing demographic, which creates an economic link between the working class and the struggling homebuyers, and this link might end up dragging everything down. The extent to how long or forcefully this chain holds down the Canadian economy is anyone's guess. Things could be severe and long-lasting, or almost negligible. I have no idea, and I don't think anyone else does either, though I can't imagine that that will act as a barrier to the wildly inaccurate predictions that tend to metastasize every discussion on the topic. But I digress. What we do know is that Goeasy has been tightening up their loan book such that more and more of it is secured by collateral. So if there is a significant increase in defaults, there will also likely be a proportional increase in the repossession of property, which can then be sold off to regain some of the loan's value. This quarter, the secured portion of the loan book grew to 41.4% and is expected to gradually increase until it reaches about a 50-50 split between the secured and unsecured loans. We also learned that despite the struggle for recent home buyers, this hasn't translated into notable economic slowdowns, at least not yet. In fact, Goeasy's automotive lending segment is performing quite well, with the company experiencing the lowest repo rate in its history, though this can partially be chalked up to Goeasy's more selective lending. However, the CEO did note that in a more certain economic environment, the company would be willing to loosen up their loan requirements. In a similarly more positive vein, on the conference call, it sounded like the operating margins still have a fair bit of room to grow as the business continues to scale, with the potential to achieve an operating margin in the ballpark of 43% over the coming decade. Or, if interest rates continue to climb, it should at the very least be able to protect the current margins from degradation. On top of that, the management commented on the ancillary products segment, mentioning that there are several new ways to continue expanding that portion of the business with product and service offerings that will benefit both the customer and Goeasy, which was the cherry on top of an excellent quarter. And I'll finish up by summarizing the management's response when asked about potential acquisitions. According to the CEO, acquisitions will be few and far between since the company is very selective to ensure that they're making quality additions that will benefit the company's future expansion plans and growth rates. So there's nothing new at the moment, but they're still keeping their eye out. And that was the quarter. After the release of these earnings, the share price did shoot up to over $127, but it's since given back some of those gains, with the price now sitting about 2.7% higher than pre-earnings. However, this is still down over 8.5% from where the share price was after the second quarter's earnings. And while the second quarter's earnings were solid, these Q3 results were phenomenal. The business has grown substantially in every measurable way, and its loan book is more stable and secure than it was last time around. That said, Goeasy still presents the same uncertainty dilemma as it did last quarter. If the company continues to grow without impediment, then the company is incredibly undervalued and could pretty reasonably 5x or more over a very short period of time. However, if there is a serious recession, we don't actually know with certainty the extent to which Goeasy's borrowers will be impacted. I think it's great that the company has been acting more conservatively, but I'm hesitant to accept the management's assurances that everything will be fine if a recession does come. Now, I will caveat this by stating that the management does have access to way more borrower information, and they're a lot more qualified than I am to speak out on the security of their loans in any given scenario. But it needs to be pointed out that recessions don't always hit in the same way, and many of the variables being used to calculate the average performance outlook could shift drastically. For example, if a large enough portion of borrowers are unable to pay their loans, Goeasy may be overestimating the amount of loan value that can be recovered through the repossession of collateral. If Goeasy ends up having to repossess, say, 10,000 vehicles, there's no guarantee that they'll be able to find buyers for those 10,000 vehicles in a recession where many people are tight on cash and may even resort to selling their own recreational vehicles or extra cars. This could mean that even if Goeasy tries to sell those vehicles at, say, 40% of their appraised values back when the loans were underwritten, there's still no guarantee that there will be buyers. Combine that with increasing interest rates, above estimated unemployment, and less borrowers meeting the borrowing criteria due to financial hardship, then we could see the company push to issuing junk bonds at horrendous rates in order to bide their time. This would likely decimate profitability and could potentially result in bankruptcy should the recession be long-lasting. Now, personally, I don't propose that this will be the case, but it is a possibility that needs to be considered when analyzing a business that borrows large sums of money to re-lend at higher interest rates to people that have a suboptimal history of managing their credit. Having said that, I do still like the risk-reward scenario that Goeasy's shares are offering, since historically speaking, recessions are rarely long-lasting, and when they do happen, they tend to be fairly moderate. Unfortunately, we only have a small sample size to go off of, and it may not be statistically significant. It could be the case that we've just been on a lucky streak of mild short-lived recessions. But this is the only data that we have, and the data does suggest that most recessions tend to be mild and last about a year on average. To give my thought process on this investment, I think that Goeasy is a strong company that is growing hyper fast, and they're rapidly approaching the point at which they're able to pay off their debts and fund their own growth. Meanwhile, the company trades incredibly cheap based on the possibility of an unusually severe recession that could blow the whole thing up. Now, to be fair, there are also worries of future regulatory changes from the Canadian federal government that do play a role in Goeasy's share price. Though Goeasy is already averaging loan rates below the upcoming regulatory changes' maximum allowable rate. Regardless, I think that the odds of Goeasy getting crushed are not very likely, and I don't think that a severe recession is very likely either. Plus, if one does happen, I think that Goeasy does have a decent shot at holding on. But this is truly Schrodinger's stock. Either the company is dead in the box or it's absolutely thriving, and to know for sure, we just have to wait and see. So while I am personally betting that it will be thriving 10 or so years out, make no mistake, this is a gamble. Of course, I do believe that the odds are heavily in the company's favor, but I will not fool myself into believing that I'm guaranteed a good outcome in this security. And that reason is why Goeasy is not a much larger portion of my combined investment portfolio. So while Goeasy does make up the second largest position in my TFSA, it's important to realize that I have other investment accounts, and the only other account that I hold shares of Goeasy in is my Wealthsimple one that I use for my $100 per month portfolio series here on the YouTube channel. And in there, it is by far the smallest position, making up only about 10% of the holdings. So to answer the question of, am I going to be buying more shares after this really strong quarter? No, not right now anyways. I'm pretty happy with the size of my position in the TFSA, and I think that there are some other good opportunities that have a higher degree of certainty that I'd rather focus on at the moment. But I wouldn't really fault anyone for making a decision to buy or hold off at the current level. It just kind of depends on how comfortable you are with the risk-reward scenario. That said, if the stock were to fall drastically like we saw a few months back when the federal regulations were announced, I'd probably pick up some shares assuming that no additional threats had presented themselves. With that, I don't have too much else to say, but before you go, I must point out that because of my ownership stake in the company, my interpretations of events and results may be biased. And while I do attempt to combat these biases at every turn, it is possible that some may find their way into my coverage. Also, I am not a financial advisor, and my opinions should not be confused with facts. It is very possible that my assumptions are incorrect, so it is of the utmost importance that you put in the time and effort to do your own research and come up with your own conclusions using primary sources before making any investment decisions. Again, I am not a financial advisor, and this video is not financial advice. I made this video for educational purposes and to highlight my own opinions. This video should only be relied upon for inspiration to do further research into the company outlined. After all, I'm just a Canadian who likes investing and sharing what I've learned with others. I hope that you found something of value in this video, and if you have, then please consider sharing it with others. Thank you for watching all the way to the end, and enjoy the rest of your day.